celebration here. Maybe it's a little premature because we are sitting at 4,999 subscribers. So I wanted to hop on here and do a special live stream here. Now, if you're just tuning in, we do fundamental analysis on this channel. The first thing I want to do for anybody that's subscribed to the channel, all you have to do, and I open this window up every once in a while, the only thing you have to do is like this video, screenshot that you're subscribed, screenshot that you like the video, and email me personally, and I will send you my discounted cash flow calculator that I have. So if you are interested in having that calculator, we've done a tremendous amount of analysis on this channel. I'll show you guys really quick what the calculator looks like. Most people probably already have a copy of it, but let me just shrink this down so you guys can see. And we're going to create a watch list really quick, and this is going to give, I'll probably end up putting the link somewhere down below at the end of this live stream to share this with everybody. So it's going to be a watch list that I think will end up doing analysis. So I'll still keep creating content, doing analysis, and then during that analysis, I will put a voting out there on the when you go to the community tab on YouTube on my channel. We will have a vote maybe once a week on a bunch of stocks that we broke down during the week or the videos that I've done. And if you guys think that these videos should be added to the watch list, there will be a voting on it. So what I'm trying to do is narrow down the amount of companies we follow and narrow it down to the biggest opportunities that are out there, because valuation is getting crazy. And I think you really have to focus on quality and valuation at this point in time. So wanted to hop on here. This calculator is going to be free for everybody. The only thing you have to do is, once again, email me personally, screenshot that you're subscribed to the channel, screenshot that you like this video, and I will get out to you guys those calculators. So it's two calculators. One is just a basic DCF one, and then one's more complex like this. Now with this calculator, the one thing I do want to point out is when you're filling out the green stuff, those are your inputs. And you really only need to be focused on the dates will be updated to current dates. You guys can knock out these dates and actually update the current years to obviously 2025 to be the forward-looking dates or the forward-looking years. But the only input you need to worry about is going to be the second window in. That's the one that registers everything. These are just used to kind of see the progression of the company that you're looking for or the company that you're analyzing. So you don't need to plug in everything. You could just put into the inputs, but I personally like when people actually plug in every number because they mentally register exactly what's going on with the company from every aspect. So everything from share dilution to revenue growth to margins to buying back stock to their cash position to their debt position. And so you really get an understanding of enterprise value of every company that you break down. By doing that, it's not the most fun thing to do, but it makes you really alert on what exactly you're looking at because you're hands in, plugging it in manually, which is boring. I'm sure somebody who's a little more sophisticated that's probably subscribed to the channel could actually mainstream this. So we just plug in a ticker. So if anybody is pretty savvy on scraping data, I'm willing to give you that calculator, and if you can send it back to me with the ability to scrape the data, so the only thing we have to do is plug in the ticker symbol, that would be huge. But guys, I did bring a beer here, so I am going to pop open a beer because it is the weekend, and I do think that we have to celebrate the small wins. And you know, we're knocking on 5,000 subscribers. Hopefully we get it by the end of this live stream, but I want to make this live stream extremely valuable to everybody that's tuning in. So the first thing I'm going to do is celebrate a little prematurely because my luck is I will drink this beer. We'll do a 2-hour live stream, 3-hour live stream. Probably not going to do that long of a live stream. And I will still have 4,995 subscribers. So I'll probably lose a few somehow, some way, but cheers to everybody. Let's get into some, let's do some work here now. First thing I want to do is actually pull up the, I'm going to pull up the watch list that I want to share with you guys. There will be a link to this watch list, guys. So the more effort you put into this, the more realistic and the more we can get out of it, okay? So the first thing I want to do is kind of just go over some of the ones that are already up here. As you guys can see here, like at this point in time, Zoom's already hit my ideal price target and it's taken off. So we can knock Zoom off of there and maybe bump Pfizer up, because Pfizer's still kind of in this area where it probably could get back down to 25, 26, maybe 27 bucks. So I actually think Pfizer's probably more of a realistic expectation to hit our ideal stock price. Zoom's already left the building, ladies and gentlemen. Zoom is on a whole nother planet at this point in time. The valuation was extremely depressed for a long period of time. It was selling like crazy, and they beat on earnings. The balance sheet is clean, so everything's working for Zoom. So we're going to update Pfizer to a 27 ideal stock price. Excuse me, that's supposed to be a 27. We've already done this valuation. I got it memorized. And then the next stock I actually want to put on here is going to be OpenText, OT, ticker symbol OTEX. It was on the recent video that I just did. Okay, so it's trading around 33 bucks a share. I think anything between 27 to 29 bucks is interesting, so we're going to put a price target of 28 on there. PayPal, once again, that one has left the building as well. So PayPal, this one was an absolute steal in the $56 to $55 range, hit those levels, and now is pushing 80 bucks a share. So this one has left the building as well. So we can count PayPal as one that we might need to revisit if it's sold off. But at this point in time, I think it's doing, if you haven't gotten in the $50 and $60 range at this point in time, I don't think you chase it. It could go higher. I just think valuations at this point in time, if you didn't get in at those levels, doesn't make a lot of sense to chase it at this point in time. So we're going to take PayPal off of there, and I'm actually going to add in Barrick Gold, ticker symbol GOLD. Once again, that was on the last video as well. Now in this video, I also want to do something here a little special. I've been getting, there's a subscriber that's requested me to do Micron a few different times. Micron was, there's so many things I've done wrong throughout investing. I've taken 10 and 15% gains when they're giving to me on numerous occasions, and those 10 or 15% gains turned into 300 and 400% gains. Micron is one of those that got away from me. And so that's frustrating. And the one thing I think I can take from that is the fact that don't sell your winners prematurely. Hold on to your winners as long as you possibly can, and don't sell them prematurely, because things could keep going in the right direction and good things can keep happening. So for ticker symbol GOLD, ideally $16 to $17. I'm going to put $16.50 in there. So that's going to be up there as well. Rounds it up to 17, unfortunately. So WBD, I have a $6 to $7 stock price. It's $6.50. So unfortunately, this thing kind of averages up. So I'd rather average down on this one. So let's just do $6 even. I don't mind gold, Barrick Gold at $17. Let me just put the 50 out there and make it 16 even. So which would be, a 15 to 16% decline on Barrick Gold. I'm definitely interested where gold's trading at this point in time. And as long as oil prices stay fairly depressed, they should have pretty strong free cash flows. So I do think they will be an outperformer. Analysts have them growing. Analysts have their growth rate at 17%. I don't know how accurate that is. Let me shrink this down so you guys can see this a little better. So Barrick Gold, yeah, unfortunately it's just not going to work. So Barrick Gold, you can see here, analysts expect them to grow 17%. I don't know if that's that accurate. If that's really what they're growing and they're trading at 11, maybe 10 times earnings, that actually makes it even more interesting, and maybe I really undervalued the valuation of this company. Nike is one that, once again, we recommended it in the basically $60 to $70 range. You can see here Nike, this is Nike here, and KE. Currently trading at 82 bucks a share. So that one is now gone. That one has left the building as well. I guess I'll put Mosaic there. And I have an ideal stock price on Mosaic sitting right around 24 bucks a share. And once again, guys, if you do want one of these calculators, make sure that you just email me personally, and I will try to email you back as soon as I can. Give me 1 to 2 days to possibly get back to you. And I will just, all you have to do is reply that you're subscribed and send the screenshot, and I'll send over 2 calculators. And then I will put a link at the end of this video for this watch list so everybody has access to it. Once again, this is a watch list for you, the viewer. The more you participate, the more, stock callouts that we get, and the more voting we get, will go up to on this watch list. So as of right now, we're just kind of doing a jumping off point. Let's take a look at other stocks that we've done analysis on here. So, I think UPS is actually getting interesting at these levels, trading at around 113. I have an ideal stock price sitting around 113 bucks. Let's take a look at UPS really quick. And I will be breaking down Micron at the end of this video. So I know that was a big call out, was Micron. So let's go here. So next up on the watch list, we're going to throw UPS up there, and we're going to, actually we'll keep GPN up there. I had an $89 stock price. Currently the stock's trading almost at $100 a share, and it dipped pretty hard. This one actually dipped really hard. So let's put UPS up there where Marvell is. UPS. So UPS is sitting at $130 a share, $131 a share. Ideally, we'd like to get in around 113 to roughly a low of a low of about 90. So pretty wide range. This is a company that, it's getting competitive. It doesn't have a huge moat, but I do think there's value there, and I do think that there is growth opportunity as well. Palantir, guys, this one is going to hurt my feelings. Let's kind of look. Palantir, I bought, this is going to kill me. I bought, I think it was 685 shares of Palantir, just under $7 a share, I believe. And I sold at $10. It made a huge move to $10 really quick. And then I just couldn't wrap my head around valuation at that point in time. Now it's at $40 a share. $40 a share, and I still can't wrap my head around the valuation on this company. But if I would have just held it at under $7, you're talking almost 1,000 shares. I would have turned basically $6,000-$7,000 into almost 40 grand in almost 1 year, or a little over 1 year. And that one is one that I am frustrated with, but at the same time, I can't wrap my head around where the company is currently trading. I don't know how they're going to get the earnings growth to warrant that demand. When I look at something like Nvidia, I can wrap my head around $5 a share. Stock could be trading at 30 times forward earnings. So you're looking at a $150 stock, and that's about where Nvidia is trading. For Palantir, I think you're looking at close to 200 times earnings on a company that's growing, maybe 180 times earnings on a company that's growing 25% maybe. Tough one. It's a tough one to wrap my head around. But I was wrong on that one. It definitely seems popular with retail investors, and it took off for sure. So that one has been knocked out of the park. It missed that one. At that point in time, I'm trying to think what other stocks we could possibly put up there that are in close to a buy territory. I think Pinterest might be one that is pretty close to, you know what? I'm going to throw Dutch Brothers up there. So this is Dutch Brother Valuation. $26 to $27 is ideally where I'd like to go to Dutch Brothers. I have an enterprise value to EBITDA sitting at $28, but from a free cash flow standpoint, it's as low as 12. This is one that you really have to really look at a multiple to EBITDA, because this is one that is a fast grower. The currently doesn't really have any true fundamentals underneath them yet. So you kind of have to lean on a multiple to EBITDA for this one. That's why there's a huge disparity on a free cash flow standpoint versus the multiple to EBITDA. So I definitely lean more on this side of the equation, which means that I could be looking at about 27, call it 26, 27 bucks for Dutch Brothers. So we're going to put bros in there. And I will put $26 as an ideal stock price. And the stock's trading at $32.50. So this is not too far off. You know, we're not asking for a huge move down here. It did hit 26 and change or $27 recently. So there's an opportunity that it could retest those levels or even break below those levels, to be quite honest with you. So I find this one interesting around that $26 range. Dutch Brothers, ticker symbol BROS. We already have Warner Brothers Discovery up there. I don't know why that's up there twice. Next up, I'm going to put Pinterest up there. And we'll also put Celsius up there as well. So Pinterest is trading around $33.30. When I look at my analysis on Pinterest, we got to find it. Hold on one second. Where is it? So ideally, I have a stock price that's sitting pretty close to 25 bucks a share. So anything under $25 a share on Pinterest is pretty interesting. I may be interested in reaching at 27, 28 and start building a very small position or using options once again to kind of get my break even lower than those price targets. But for Pinterest, I do think it's interesting here. They're projected to grow around 7%. Pretty rich valuation on a company projected to grow 7 to 10%, but that's why we built some safety in there, and we'll stick to the $26 price target. Was it 26? Oh, I'm sorry, 25. 25 and below. So on Pinterest, we're looking for a break below 25 bucks to possibly get interested in the stock. You know, this is pretty boring stuff here, but Coca-Cola was actually on my watch list, guys. Coca-Cola was on my watch list. It did hit 46 bucks, I think. I had an ideal stock price at 48. Take a look at where Coca-Cola is trading for right now. $70 a share for Coca-Cola. This is why valuation is important, because sometimes we look at these kind of boring stocks that just get overlooked or have depressed valuations. And when they surprise on earnings, you're going to see this thing take off. And that's exactly what's happened with Coca-Cola. Through this high inflation, they've been able to manage it. They've been able to grow their earnings. And so what has happened, the stock shot from 48 bucks a share to $70 a share on a company that's been paying dividends for I don't even know how long. But to see that kind of capital appreciation is extremely impressive for a kind of a boring company like Coca-Cola. So this is why it's important to kind of look at valuations. And actually, the company I'm going to put up here is going to be Smuckers. So Smuckers has been a massive underperformer. It's one that I've done a valuation on numerous times. Currently trading at $117 a share. We're going to replace Coca-Cola with Smuckers at this point in time. Coca-Cola is gone. I wouldn't chase it at these levels. Personally, I just think it's a little rich at these valuations. But I think Smuckers you can make a bullish case for, especially if the consumer slows down and they can get cost under control. The consumer slowing down, as I mean eating out and starting to do maybe more shopping at home. So where do we have a valuation on Smuckers? Basically a $91 price target from a multiple to EBITDA and a $150 price target from a free cash flow standpoint, which either one I would lean on, but so that gives me an average price target. I like the stock under 110, to be honest with you guys. So I'm going to put a $105 price target on Smuckers, ticker symbol SJM. I think they have some headwinds that could cause the stock to sell off from 117. So that was 105 is an ideal stock price. So you're looking at a 10% move down for a company excuse me, you're looking at like a 10% move down for a company like Smuckers at this point in time, in my opinion, where it becomes very, very appealing from two perspectives. Number one, you're going to get over a 4% dividend yield, and they've been paying that for over 25 years, I believe. And then on top of that, you have that capital appreciation. You built some safety into the stock, buying it at these levels, pretty depressed, historically pretty depressed levels for a company like Smuckers. Tyson Foods, we had an ideal stock price around 46 bucks. This thing shot up, I think, to high 60s and now starting to sell off. This is one I would have to revisit. Don't know where I stand on Tyson Foods as of right now, guys. Ticker symbol TSN. Not really sure where I stand with that one. So we're going to put Celsius in there because I have a better understanding of where Celsius is. So I'm just looking for my Celsius valuation real quick here. And if you guys have any questions or comments, definitely leave them in the comments section. Or leave a comment. I will try to get to it at some point in this video. But I do have a lot to kind of get through here, so be patient with me here. So as you guys can see, 26 bucks from a free cash flow standpoint, 29 bucks from a multiple to EBITDA. And I did write cash secured puts on this one with a break even price target of $29.75. So I am in this position. I will limit my holdings if we get a pretty substantial bounce in the stock. It's pretty oversold. But at these levels, I do find Celsius pretty interesting. Once again, my biggest concern with this company is the questionable moat that's behind it. The company's deploying capital extremely well. They're growing at a very, very high rate. Valuation seems to be pretty reasonable. It's not cheap, but it's definitely reasonable. So multiple things I like about this company. So I'm going to put a $28 ideal stock price on Celsius Holdings, ticker symbol CELH. Cisco Systems, guys, you know how bullish I am on Cisco Systems. And this one actually has taken off as well. Cisco Systems has done fairly well when we look at you look at multiples on a lot of these technology companies, and two companies I kind of got made fun of for really getting interested in. It's pretty funny, like, you get made fun of, and then those people that make fun of you on the channel or leave a rude comment never come back and say, hey, you know what, you were right. And two companies that I was very, very bullish on, believe it or not, number one was IBM. Okay, you can go back through my videos a year ago, and I was saying IBM is an absolute steal at 130, 140. People made fun of me for this because they said it's a dead company. And I explained that the macro environment of AI, IBM was there before anybody else, and that they were in the right place at the right time, and valuation was cheap. They don't even have to execute at a high level for them to get any sort of multiple expansion. And so that was one that I got made fun of. And IBM is trading what, over $200 a share? Let me take a quick look here. But the second stock that IBM is at 226. It's up over $100 a share. IBM is up over $100 a share, and I caught so much flack for saying that this company will be an outperformer over the next 12 months, and that was a year and a half ago. And man, this has been a monster outperformer. And I kind of feel the same way about Cisco Systems. Kind of getting overlooked, not really a sexy company, low multiple, high dividend yield. Just nothing seems wrong with the company. They've made a tremendous amount of acquisitions. Now the question comes down to, do these acquisitions start paying off? Do we see multiple expansion? Do we see margin growth? And that's going to be the big question. Love the acquisition of Splunk. I thought that was one of the best acquisitions that I've seen in a very, very long time. When we look at the valuation of a company like Palantir, and then you say they essentially acquired a company very similar to Palantir in Splunk that's doing more revenue and was growing at a higher rate, and they bought them for like $28 billion in cash. Palantir is pushing $80 billion market cap, $90 billion market cap. Tell me that return on investment is not going to pay off for Cisco Systems. So that's one that I actually really liked as well. So we do have Cisco on here. I do think most people probably missed the ideal entry point on Cisco Systems, but still pretty interesting in the 40 range. It's sitting at $52 a share. I had an ideal price target at 42, but as you guys know, I did kind of get into it around 45. So paid a little bit more for what I thought is a high quality company, a safe bet. I kind of feel the same way about a Pfizer. I'm okay reaching at Pfizer, even though I think ideally it's a $27 stock. I'm okay reaching a little bit in the low 28s, high 27s. I feel the same way about Cisco. If it gets into the 40s, mid 40s, low 40s, I think you got a great buying opportunity on Cisco Systems. I think there's multiple tailwinds for this company. It's funny. Gilead Science was another one I was very, very bullish on. Pfizer really has not participated in this biotech rally at all, or biopharma rally, I should say. We were very bullish on Gilead Science around $60 a share, and it was paying a hefty dividend. Not only did you get a hefty dividend, I think it was over 6.5%, but you got tremendous capital appreciation in a very, very short period of time. So yeah, I'm going to keep steadfast. I'm going to still say $65 gets interesting on Gilead Science. Believe it or not, somebody asked me about GSK today. I haven't done an update on this one, so I don't want to put anything in there as of right now. So we kind of just did a quick run through on some stocks that I think are pretty interesting at this point in time. Some stocks that I think you can kind of take a look at on a pretty significant sell-off. And I think they're pretty good quality companies. Actually, let me throw one more up there that I have done that I think is pretty interesting. That's going to be Kroger, ticker symbol KR. Let me see where I'm at with Kroger, because I think this one might be pretty close. Maybe not. So from a multiple to EBITDA, I have a $40 price target, and from a DCF model, I have roughly a $50 price target. So let's meet in the middle and call it $45 a share for Kroger's. So I'm just going to replace GSK with KR right now, because at least I understand where I'm at with KR. KR is trading at $55 a share. I ideally would want to get it around $44 a share. So we added KR, Kroger, ticker symbol KR to that as well, right here. So currently Kroger, ticker symbol KR, is trading at $55.90. I have an ideal stock price sitting pretty close to $44 a share. So that is an interesting one as well. I'm probably going to leave it there for the and zero out the rest of these. Actually, Airbnb I do have a valuation for. Let's update Airbnb. Airbnb needs to fall a pretty significant amount, I believe, especially where it's currently trading as of right now. So let's just see where Airbnb is. Where are you at? I'm having a hard time following. This is the other reason why it's hard to follow this many stocks. I would say kind of my whole thesis is, if you're doing models and you're following the earnings calls and you're doing like all the right things on, now some of these companies you don't really need to do it for. I think your Mag 7, you kind of, what you see is what you get. They're pretty much, you can turn on the news and hear everything you want about the Mag 7s. They're pretty well priced, and they're pretty well followed. So the news drops pretty quick on your Mag 7s. But if you're buying kind of these not as popular companies, the ones that are not part of the Mag 7s that are being pumped down our throat all the time, then I tend to think, the way I kind of break it down, I don't know where my Airbnb valuation is, but the way I kind of break that down is the stocks that you kind of need to follow, whether that's updating your DCF models, whether that's listening to the conference calls. You know, first off, let's start that everybody should have a big portion of their portfolio based in a set it and forget it index, a global set it, forget it index. But when you're taking on individual equities and you're buying individual equities, kind of how I look at this is, depending on how many hours a week you can devote, to looking at your stocks, you know, doing the calculators, listening to the conference calls, touching in with your stocks every, once in a while. I would say a half an hour to an hour for every stock that you own is probably kind of what you need to put aside. So that means if you let's just say you have 20 individual stocks that you're kind of following. I would say every week you probably need about 10 hours, close to 20 hours on some weeks, especially when earnings season kicks off. you probably need 10 to 20 hours to really follow and understand what is going on with those companies. Because otherwise you're buying a company, and if you're not following, when you should be getting in, is it overvalued? Should you be taking profits? Or is the company outperforming, and is it undervalued? Do you need to add more? I always say that's kind of a good area a good amount of time to delegate, I personally believe. Okay. So that's me personally. Just depends on how much time you have to dedicate to individual stocks. So something your Mag 7s, I really think you can kind of set it and forget it, because most of the Mag 7s, they have multiple revenue streams, your Googles, your Metas, your Apples. So it's multiple businesses really under one umbrella. I would actually be okay being a little bit more overweight those companies, and you don't necessarily need to follow them as much as you would a company that's not being covered. But the issue with those is being able to buy them at the right price, because to me they're pretty expensive. Okay, I don't think they're a screaming deal by any means. So just my opinion though. Okay. So let's move on to breaking down a stock together here. So let me duplicate a calculator really quick. So guys, give me 1 second here. I got to find a calculator that I can duplicate. And if you're just tuning in, if you're subscribed to the channel and you like this video, screenshot that to me. Look up my personal email, send me that screenshot, and I will forward you one of these calculators. So you can come back to this video and kind of see how I break down a stock. Not saying it's right, not saying it's wrong, not saying I know what I'm doing. This is not financial advice, but I hope that this helps people. That's all I'm trying to do, guys, is give you a process. Because I truly believe you can get lucky in the market and people can look smart for a few years. They can buy something that takes off. But having a process and being consistent and being, having the mental fortitude to handle the wins and losses is what makes a good investor, in my opinion. So if you don't have a process and you were able to get lucky, then that's good for you. Because at the end of the day, your brokerage account is the scoreboard, right? So if you're winning, you're winning. But if you're losing, you might want to have a process and you might want to figure out kind of what's going on here. So we're gonna oh, it already exists. Hold on 1 second, guys. I guess I already have this one done. Give me 1 second here. I guess I have Micron done. This one's gonna make me sick because I do have it done. It's right here. You guys are going to think this is nuts, but this is the opportunity I missed with Micron. So I actually liked Micron between 44 and 50 bucks a share, okay? I haven't done an analysis on this one in forever. So we're going to do this together. Let me just pull up something here. And guys, if you can just smash that thumbs up for me, would greatly appreciate it. So if you're just tuning in. So we're going to break down Micron together, and you can always come back to this video to kind of see how this calculator works as well. So I'm going to make this fairly quick and painless for you guys so we can kind of get on some more topics here. But first thing I like to do is just kind of check sentiment around the stock. We have a low of 90, a high of 250. This is a company that's projected to grow 55% next year or in 2025. So earnings are projected to come in around $9 a share, $13 a share. I'm not sure what's going on here. I'm not sure what the heck's going on here, but where is the trailing? Yeah, 61% revenue growth. Let me just see something really quick. Well, really quick, guys. Cheers. I'm going to have a sip of beer. This is not a recommendation to drink alcohol and gamble in the stock market, but we are drinking alcohol and talking stocks. So what else would you rather do on a weekend? So Micron has had ridiculous growth. Okay, this is, once again, what are we learning about this? This is the reason why following too many stocks is dangerous. I missed a huge opportunity on Micron because I had between a $44 to $50 stock price, and it did, I believe it did get down to those levels. And this was over 2 years ago that I had this stock price. So let's just take a look at the chart really quick, make sure I'm not fibbing. Maybe I am fibbing. No, it's right here. Okay. All right, we're good. All right. So here's Micron's chart. And here's where I kind of did my analysis. The stock got as low as $36 a share. Guys, the stock's trading for $102 right now. My recommendation was a $44 buy target. Okay. So I look like a clown. Yep. I look like an absolute clown, but at least I'm showing you that I have a process that seems to be working, right? We went through a bunch of different names that have outperformed. If you want to go through my old videos, another opportunity that I missed is Sprouts Farmer Market. It was an $18 stock. Now it's over a $100 stock. Let's actually take a look at Sprouts before I dig into Micron, because this one had a ridiculous run. It's at 112. My oldest video on this channel is Sprouts versus Kroger. And I was bullish on Sprouts. I thought Kroger was already fairly valued. Sprouts was at 18 bucks a share. Pretty ridiculous. But let's get back to Micron, guys. So let's talk through Micron really quick. This is going to be a tough one because the growth rates are extremely high and it's a mature company. So this is where it gets more difficult to really play, to really build a story, understand like what's going on with the company. Okay. So it looks like trailing 12 month is sitting at $21 million, $21 billion, excuse me. But when I look at forecasts, they're projected to do $39 billion next year because of the demand that's out there right now. And that's going to grow earnings to $9 a share. But then what I'm not understanding is this massive dip on earnings in 2027. Like, that doesn't make any sense to me. So I'm not understanding that. It's okay. We don't need to understand that. What we need to understand is what the growth rates are going to be and where do we need to jump off when it comes down to revenue at this point in time. We're going to use historic EBITDA margins. We're going to use historic. Let's take a look at the balance sheet really quick. The only thing I want to get a grasp of is where revenue growth should be, but I want to take a quick look at the balance sheet as well and just make sure I'm not missing anything. Okay, company has $9.5 billion in cash and cash equivalents, and total debt sitting at $13 billion. So overall, pretty good balance sheet. What does this company usually cash flow? About $2 to $3 billion, and that was on how much revenue? Back 2021. So about a 10%, 11% free cash flow margin looks like historically. Just kind of spitballing it here. So we'll go free cash flow margin. Yeah, that's fine. Okay. Then we got to start plugging in some numbers. All right. So you guys are kind of seeing what I'm thinking here, or what I'm starting to do. I look at the balance sheet. I look at what growth rates are going to be. We're also going to check Yahoo for their growth rates as well. I want to make sure there's a consistent story being told here. So this is pretty wild. This is what I'm not understanding is they're projecting them next year to have this massive spike and then not be. So Yahoo's kind of doing a similar thing that Stock Analysis is doing, where they have a huge spike in revenue, but then next 5 years are projected to kind of come down from that 40% revenue growth. So here's what I'm going to do. I'm going to bump up their revenue to that 30 billion market cap, or that 30 billion top line revenue, but I'm also going to keep the growth rates near their historic growth rates, which is about 5 to 6%. So let's start fiddling around with this a little bit here to kind of get an idea of what we need to be looking at for Micron. So with this calculator, guys, you start at the top left-hand corner, you put your ticker in, and then you start thinking, you kind of start building your thesis, okay? So it looks like they're going to do, most experts have them doing between 35 to 39 billion next year and 46 billion by 2026. I'm going to drag this out a little bit longer. So here's what my thought process is. I'm going to say that what I want to do, and hopefully this makes sense. So what's taking place with Micron is there's this massive spike taking place, okay? What I want to do is I want to smooth out that massive spike. I want to give it a consistent growth rate, and I don't want to put that it's going to do 40 billion next year and then it's going to come back down to 30 billion. What I want to do is smooth out this story. So I want to say that instead of them doing 46 billion by 2020, call it 2024 or 2026, I'm going to say that in 2025 they're going to do 33 billion, in 2026 they're going to do 36 billion, and in 2020. So I'm going to smooth out the story a little bit so we get a more realistic future value for the company, because we don't know what 3 years from now is going to bring. So let's smooth out this story a little bit. So if you're following me, give me a thumbs up and let me know that you're understanding what I'm kind of trying to do here. Okay. Historically, the company grows between 5 to 6%. So we'll go 6%, 5%, and 4%. So we're using 6%, 5%, and 4%. But the question is going to be, at what point do we want to use the growth rates that make sense? So with this one, it's an older dated, so I got to update the dates here. So we're thinking 2025 projected earnings, 2026. And already I'm going to bump up these growth rates a little bit because it's not really hitting where I want it to hit. I want them to be getting close to 40 billion by 2027. So 7, 8. Sorry guys, just give me 1 second here. Bear with me. I'm not the best multitasker for sure. Okay. So now we're here, we're talking Micron in 2033. What's Micron going to be worth in 2023? Okay, so we have to flatten out this huge spike in revenue. So I'm trying to give myself a story here that makes sense. So I want them to be doing right around $40 billion, 42, 43. What was it? What was the projection at? Just to make sure. So they're projected to do 46 billion in 2026, but I want to push that out to 2027 to smooth out the story. Okay. So we're going to use, we'll bump it up 1 more percent. And then we'll bump this up by a few billion here. Okay, perfect. Okay, we got what we want. So I want to kind of go over the story with you guys here. So we have them growing 8% and then 5%. And in 2027, they're going to be doing right around $42 billion, 2028. And you guys can see the steady growth. So instead of using that huge spike and then being unknown what they're going to do past 2026, a lot of the analysts are kind of making this pretty confusing. So what I want to do is just smooth out the story so we can get a more realistic price target on the company. So that's what I'm basically doing. Okay. So we have that now. Now we have to start looking at their margins. Okay. So as you guys can see here, we have EBITDA margins are down next on the list. So we finished revenue growth. Revenue growth looks to be in line. So now we're coming down another bracket and we're talking about their historical EBITDA margins. So we want to go here. We want to take a look at the financials. And then we just want to scroll down to their EBITDA margins. So historically, this company does high 30s to 40% EBITDA margins. Okay, very, very good margins here. So we're going to bump that up on our analysis. And we're going to say that they're going to do 35%, 40%, excuse me, 40, 40%, and we'll go 42% EBITDA margins. So I'm telling myself a story that revenue growth is going to stay consistent. EBITDA margins are going to grow as they go on. And then their revenue to free cash flow is going to sit right around 10 to 12%. So that looks fine. Cash growth. Let's see how much cash. They had $9 billion cash on their balance sheet. So that stays the same. Debt is sitting at, really quick, let me take a look at the debt again. I know we went over it, but my memory is not that good. So give me 1 second here, guys. We're going to take a look at the debt. Okay. Take a look at the balance sheet, and the debt is, so we want to look at debt and shares. We want to see if they're buying back shares, and we want to see if they are knocking down their debt. That's going to be the key to this last exercise. So they have 13 billion in debt. So the debt did grow, actually. It went from 7.5 billion to 13.9 billion. And shares are actually growing as well. Interesting. So that's pretty interesting. They had what? 1.2. 1.2. Huh. So, you know, I know the stock's looking interesting here, but I'm actually surprised that the debt has doubled like that. And then we have 1.2. Okay. So we're good there. We're good there. All right. Now we have to figure a multiple to put on the stock. We have to figure out a multiple to put on the stock here. Let me see. Revenue free cash flow. 842. I'm just making sure everything looks good. Required rate of return is 10%. Let me just make sure. Yeah. Okay. Required rate of return is 10%. Okay. Now the key and the hard part about this is actually figuring out what kind of multiple we want to put on the stock. Okay. So terrific growth rates over the next couple of years. It looks like we're going to see a huge bump in their revenue. Then we see it fall off, but nobody really knows what the revenue growth is going to be. So that's why I want to smooth it out, make it kind of historic to what they've done, and not give them that huge spike. I'm smoothing out that spike to kind of get a better idea of stock price, because what's going to happen is everybody's going to buy this stock on that huge revenue spike. But what do we know? We know that that spike doesn't look sustainable, right? On all analysis, it looks like they're having this huge demand that's going to slow down after 2 or 3 years. So we're kind of getting ahead of everybody and saying, at what price point do we want to pay for Micron? Because what's going to happen is it's going to have a massive following, a massive spike, a euphoric behavior. So if you're not in now, at what price point do we really want to be looking at Micron? So that's kind of where I'm taking this as of right now. So that's kind of where my thought process is. So let's do this. We have everything plugged in. Now it's coming down to a multiple that we want to put on the stock. So I like to go to Seeking Alpha for this because they compare them to their peers. We type in ticker symbol MU. Hopefully you guys are finding value in this. I don't know if you guys are finding value in this, but once again, if you do want one of these calculators completely free, I do this every once in a while where I'll do a live stream, give out these calculators for free. And since we're hitting 5,000 subscribers, this is a gift to you guys, and hopefully you enjoy it and find some value in it. Okay, so we go to valuation at Seeking Alpha. We go right up to the top to valuation. We can see here that the trailing 12 month, the company's trading at 146 times earnings, but the forward Gap is sitting at 12, which is making it look really cheap. But once again, what do we know? That huge spike is coming with a possible decline. So very, very interesting scenario here. Now the question is going to be, what kind of multiple do we want to put on it? The trailing 12-month EV to EBITDA is sitting at 13 times. Industry is sitting at 18 times. I think this is a company you can look at paying 15 times for. So kind of meeting in the middle here, paying maybe 15 times multiple on it. And so from a multiple to EBITDA, this looks really, really cheap. I just want to make sure I'm not missing anything here because this seems a little ridiculous. What am I missing? What am I missing? Actually, I'm going to put a 13 multiple on it. So we have the revenue. EBITDA looks right. So we get two price targets here. Okay, the first price target is the free cash flow price target. You know, this is a company that's going to do, I have them doing, in 2033, I have this company doing $55 billion in top line revenue. If they have a free cash flow margin sitting around 12%, that gives them a $6.6 billion free cash flow. When you look at the multiple that it's trading at right now, it's extremely rich from a free cash flow standpoint. The multiple expansion on a lot of chip makers, I honestly can't wrap my head around. I really can't wrap my head around. I think I'm going to lower the growth rate from years 6 through 10. Yeah, I like this a little bit better. Okay. So let's go over the stock. Let's go over the two stock prices we get. From a multiple to EBITDA, I think it's a $99 stock. We could be looking at fair value sitting around $99. From a free cash flow standpoint, I honestly think $42 a share is pretty low. But when you see the problem is you're paying a high multiple for any of these chip makers right now. It's a euphoric behavior and multiple expansion with the chip makers. So I'm going to give it a price target between 75 to $80 a share right now on the projections of what they're doing. So on the projections of what they're doing, currently the stock's trading at $102 a share. I'm putting a $75 to $80 price target on Micron. This is one I kind of want to monitor, so I am going to throw it up on our watch list. This is one I kind of want to monitor here because I'm not understanding the revenue. So this one's unclear to me, guys. This is one I'm not confident in giving a price target for, but just kind of do it in on the fly with you guys on a live stream. From what I see, I think it's pretty interesting around 75, $80. So I'm going to put $75 a share on Micron. So, yeah. It's a tough one, guys, because of what they're projecting out for the next year and then that decline that comes 2 or 3 years later. This is one I want to monitor. This is one I really want to monitor because I think fair market's probably sitting 75, maybe $80 a share. That's building some safety in there. That's putting a 10% rate of return in there. So I think you have some safety built in that. I don't think I would chase this because of the way the revenue explodes and then comes back down. I think it's a dangerous stock to kind of chase after, unless if you're just trading it. But if you're looking at it as a long-term investment, it looks like the revenue is going to decline. And if people start chasing this up and earnings start to disappoint, you could see this thing whipsaw pretty hard. So that's kind of just my take on Micron. So yeah, we'll probably leave it there. If you guys have any questions or comments, definitely leave them in the comments. Right now, I'll try to get to them, and I am gonna put this link in the description here. I'll put it in the comments right now, so anybody that's live now that wants to see it. And we did it, guys. 5,000 subscribers. Woo! Cheers. Cheers to the weekend. It was a slow grind to 5,000 for sure, but I really love the people that are dedicated to the channel. I love the people that take these analysis with a grain of salt and say, I'm not going to be perfect. If anybody on YouTube is perfect, they're not making videos and trying to help people, right? They're making a crap ton of money. But what I try to do is when I'm working throughout the day, I try to make a video on something that I found interesting. I try to show you guys a process of how I get to these prices. I don't just pull them from thin air. I have a process on how I get to them. That process has served me well. It served my wife's portfolio well this year as well. But you do get some losers. You do. That's why you can't put all your eggs in one basket. You can't get overexcited you can't let greed take over, right? So like, I think it's okay to have a very concentrated portfolio. I think that's completely fine. But I also think you have to understand that there's going to be things out of your control, even though you've equated for everything that could take place that really can ruin your investment. And that's why you can never go all in on one stock. But I think concentration is a good thing, right? Concentration is a good thing if you know what you're doing. Thank you guys so much for the kind comments. Appreciate it. But yeah, concentration is okay if you know what you're doing and you're staying on top of it and you're using that time allocation that I kind of mentioned earlier in this video. If you're doing that, then I think it's okay. But for the 99% of people, they should just be, a majority of their portfolio should literally be set it, forget it, global diversified index, and then speculate with maybe 1 to 5% or maybe 1 to 10% depending on your age bracket. Speculating as far as buying individual equities. So a lot of the stuff we do on this channel is giving you that process and showing you like, hey, this is how I'm not going to be at 100% right all the time. I told you guys right off the beginning, there's a bunch I've missed because these stock prices got away from me. I couldn't wrap my head around valuation. And so what do we learn from that is that when you're in a stock and it's winning, don't sell out on the whole position. You know, and I'll give an example. So like on Palantir, okay? Palantir I bought around 6 and change, almost 1,000 shares. That $6,000 would be worth $40,000 right now in less than 2 years, okay? Or right around 2 years. But if I would have just sold 45, 50% of my position when it went up 30, 40%, and just let the rest kind of keep going in the direction that it's going in. Because for me, it was a long-term hold and buy. I thought it was expensive at $6 and $7. How expensive do I think it is now? I think it's extremely expensive. I understand the path that they're going on. I understand the opportunity. But when you look at the valuation, like, it's wild. To me, it really reminds me of Cisco during the dot-com bubble. A lot of people want to equate NVIDIA to Cisco. I don't see that. I think NVIDIA's earnings make sense. $5 of earnings, 30 multiple. I can get behind $150 stock price on Cisco. 40 cents of earnings, maybe 50 cents of earnings for, actually, let's take a look at where they're projected to come in at, because I don't want to misspeak. So even just looking at what experts think, you have a low of $9 and a high of 50. I mean, this might be one of the most wildly disparate stocks differences that you see, both bulls and bears. People are extremely bullish on it. People are extremely bearish on it. Some people think it's extremely overvalued. I got to be honest. I thought $9 is where it should stop. That's essentially where I sold it at. 33% gain in a very short period of time I was pretty happy with, but now that it's shot up over 400%, not as happy about that, but it is what it is. But when I look at this, guys, like, it's pretty much simple math here. I was pretty close. I said 40 cents of earnings, so they're projected to do 44 cents of earnings on 20% revenue growth. Okay, now, nothing wrong with that. Okay, these are strong numbers. I'm not knocking the numbers, but if we just do some quick paper math here, it's pretty eye-opening how expensive this really is. I'm not understanding. The only thing I can equate it to is what happened to Cisco in the dot-com bubble. It's the only thing I can make sense of, because we're looking at a company that's trading at, call it $40 a share right now. It's going to do 44 cents of earnings. You're looking at a 90 PE ratio on a company that's growing revenue at 20% and maybe gets earnings growth at 25%. 20% revenue growth. 20% earnings growth. So not getting this one, even if you go to 2026 and go 2 years out and say that they do 50 cents of earnings, even if you do that and go off of 2026 numbers, right? We'll call it 56 cents. You're still looking at a 71 PE. 71 PE ratio on a company growing less than 20% at that point in time. So this one is one that has been one that's kind of gutting me. I'm not gonna lie about it. I'm always straightforward, guys. I got nothing to hide. I'm not trying to pretend to be driving a Ferrari. I'm not trying to pretend to know it all. But I do think I have a pretty good process. I think I'm pretty transparent. I try to line up the charts with the fundamentals. I try to be completely transparent with everybody. I literally have shown you guys companies that I've sold that have went up 300-400%, and it's pretty discouraging. And the lesson that I have to learn from this is when I'm very convicted on a position and I want to hold it for longer than maybe the returns allow me to, then I have to sell out a portion of my position that makes me happy enough to, if it goes back to where I bought it, then I'm completely fine, right? So that's something I actually personally have to work on, something that I've messed up on. So we're never going to be perfect. Obviously, I'm going to make mistakes, but try to do my best to help people as much as I can. Guys, I'm going to end it here. 5,000 subscribers. Can't thank you all enough for the positivity. Love you all. Thank you all. And 2025 is knocking on the door, and it's going to be a very, very interesting year. Want to let you guys know that I want to work on this watch list. I want people to have access to it. I want us to vote on stocks that should be in the watch list, stocks that should not be in the watch list, because at the end of the day, I'm just sending the message, you guys are in control of this watch list, okay? So we're using my analysis, we're using your voting rights. So it's checks and balances on what companies belong on the watch list. I would like to narrow it down to maybe 10 to 20 companies that are high quality, undervalued, that could have outsized rate of returns, okay? That's the goal of the watch list. With those 10 and 20 companies, between all of us, we should be able to keep each other in the loop, follow it, and understand when it's cheap or when they're expensive, and when we should be adding new stocks to the watch list because some of the other ones took off. Just like PayPal took off, just like Sprouts Pharma Markets took off, just like Palantir took off. Those companies took off. I would not be chasing them. I'd be looking at other opportunities in the market. If you already built into those positions, congratulations. Let it ride. Start taking profits when you feel it's appropriate. But going forward, it's kind of turning over those stones and looking at deep value, undervalued stocks, that companies that are getting high rates of returns, companies that have outsized EPS growth that maybe the market's overlooking, and companies that are well managed. But as always, guys, appreciate your time. Thank you so much for spending it with me. And we're going to cut it off here, guys. Love you all. Appreciate you all. We'll see you in the next one.